I just told me, yeah, we gon' be straight. He saw me make $1 million off one damn play.
What it do, guys? Welcome back to the channel where we are focused on building wealth in the stock market. Today we're going to be talking about why the stock market is crashing, okay? Over the past month, basically, it seems like the stock market has just been on the downturn, okay? But in this video, I'm going to break down why that is, what's going on with the news, and just know that it has something to do with bond yields. Okay, if you don't know what that is, stick along because I'll be breaking down what that is and how that typically affects the stock market, okay? Don't forget to like, comment, and subscribe because, I do a lot of stock content, but let's hop directly into this topic, okay, guys? So here's an article that says, global stocks tumble as rising bond yields worry investors with all eyes on Fed Chair Jerome Powell. Okay, so basically Jerome Powell is a Fed chair and he discusses interest rates, bond yields, and everything dealing with the economy. Okay, guys, so investors look to him to hear information or news about where they should put their money. That's basically what this boils down to. Where should investors park their money so that they get the best return with the most limited risk, okay? So let's hop into what this article is saying. It just outlines a few things. It says global stocks tumbled on Thursday after rising bond yields triggered a sell-off in U.S. tech stocks. So the U.S. tech stocks have really been hit very hard. It's very attractive to investors because U.S. tech stocks basically have a good return. They have high growth. So investors put their money there so they can get the best return on their money. You want to use your money as a tool so that it can generate more income for you. Okay. It says Fed Chair Jerome Powell is due to speak with investors keen to hear his views on the bond market. Okay. So I'm going to break down the bond market versus the stock market in the next clip. Okay, guys, that's basically going to give you give you some knowledge or background on what's the difference and how that works. Okay, so here is a beginner's guide to bonds versus stocks. It says stocks and bonds are often paired together when talking about investments, but their risks, returns, and behaviors have stark differences. So that is true here. Okay, so let's break down stocks. We all know about stocks. Stocks are basically where when you purchase a stock, you basically purchase partial ownership of that company. The more shares you buy of that company, the more ownership you hold within that company, right, guys? So it's a equity-based investment because as the company grows, you grow with it, or your investments grow with it. So that's how stocks work. Now let's dip into bonds. Bonds are a loan from you to a company or government, okay? So instead of putting your money somewhere for it to grow, you are loaning your money a certain amount so that you get paid a set interest rate on your money, okay? So it's not equity based. So, you keep your initial investment and let's say you are paid, here it has an example of you're being paid 2% annual interest for 10 years. Okay, so it's like that. You give money and they pay you interest for using your money. Okay, you're basically providing a loan. Just how we go out and get loans, we are providing those loans for others. Okay, so that's how that works. And investors are trying to see what is the best option for them. Okay, if they should park their money in bonds because it's safer at the moment and they don't know what's going on with the economy, or if they should still stick with stocks and have it equity based and basically grow with that company. But let's dig into the risks, okay? So we know with stocks, if a company goes down, you basically go down with it because you have partial ownership in that company, okay? Now with bonds, the risks are that if that company that you loaned your money to, doesn't work out, or, it doesn't work out with the government, then, you may not get that money back. So that's kind of where the risk lays within all that. Okay, so now let's discuss what it would mean if bond yields were being raised. So, okay, let's think of it like this. Interest rates, bonds. Bonds are basically you are giving a loan to someone else, a loan of money to someone else. Let's say your cousin asks you for $1,000. So you loan them $1,000 and you say, you have to pay me 2% interest every year, for this amount of time. Okay. So that's how a bond would work. But the interest rates, if rates are going up, that means that you can tell your cousin, you know what, you're not going to be paying 2% annually each year. You're going to be paying 4%. Okay, let's say you doubled it. So that means you're getting more of a return for loaning your money out. So with bond yields, the rates going up, the interest rates going up, it shows that investors who loan their money would be getting more of a return on that. So that's why the stock market has been, going down, because a lot of these big investors are taking their money out of stocks and, trying to decide if they should put that money into bonds rather than have it in the stock market. Okay. So that is causing a great, a great fall within the stock market. Okay. It's just a transfer of funds. A lot of these huge investors, billions of dollars, are taking their money out of the stock market and trying to see if they should put it in bonds for a better return on their money. That's basically what it is, guys. And retail investors like me and you, we see that it's down, and a lot of people, this is something that should not happen, but a lot of people see that the stocks are going down, so they are selling out as well. So it creates a domino effect, if you will, saying that they see the stock market is going down because these huge investors are pulling out. So now retail investors are pulling out as well, causing a chain reaction, just, having the market dip more and more. So that is basically a brief explanation of what's happening with the stock market and why it is dipping or crashing. Okay. I'm not a financial advisor, but this is a very great dip. So if you are starting to invest, it's good to buy at low prices so that you get more of a return when that stock shoots back up. Over the long term, we know that the stock market goes up anyway, so it wouldn't be a bad idea to invest at low prices. But that's just my little 2 cents. I broke down basically what stocks versus bonds were and why and how that has affected the stock market. If you guys learned from this video, if you learned anything from this video, if you enjoyed the content, don't forget to like, comment, subscribe. Let me know what you guys think down below, and I will see you guys in the next video. So let's get it and let's go.
I just told me, yeah, we gon' be straight. He saw me make $1 million off one damn play.